Hey guys, it's JP Invests, and today we're going to be talking about 4 or 5 bond funds that I think could be really good investments to get a nice yield and a very good price basis where we could get some nice capital appreciation. Alright, taking a look, just a little overview of the portfolio. We are at $23,416 in the main portfolio. Sometime I want to have a video going through my portfolio and my holdings. I also have my Roth IRA and one other portfolio through Webull. I might be showing the Webull, but I can for sure show the Roth IRA because it's through Robinhood also, so that should be pretty easy to show my holdings inside of that. But overall today, not doing the best. On the week, we are doing pretty good, up 5.5%. On the month, we are up 1.1%. On the 3-month, we are down 6.48%. And on the year, we are up 20.15%. All right, diving into it. We'll start with Vanguard Tax Exempt Bond ETF. So, the premise with why I want to invest in bonds right now, bonds are devalued substantially right now. And that is because of the interest rate hiking and how fast it's happened. And to the rate that it happened, the interest rates are higher than they have been in 15, 20 years. So, right here is the 10-year rate, and we are currently at 4.52%. This was all the way up to 4.92% in October 16th, and that is when we saw another pullback. And since we've seen this little pullback of rates off the 10-year treasury, we have been able to see the stock market show a little bit of resilience, and also these bonds being able to bump off the bottom. So, looking at the first bond, we're looking at just a Vanguard tax-exempt bond ETF, and we're looking at the 5-year. This has been devalued substantially, but this one is going to be showing it to the least. I'll show you guys a little bit later. I'll show you in the next example, the next ETF, one with a little bit more length exposure to longer loans exposure, and it'll have a greater interest rate risk because of that. But this one has a pretty good potential return once rates come back down, potentially going back up to about 55 to in the 50s, mid to higher 50s. Currently, we're at just at 48.60. And with a tax-exempt bond, they're going to be investing into muni bonds, and those are going to be for infrastructure for your city and stuff like that. So they should be low risk of failure. It should be like California, Illinois, places like that shouldn't be going fully bankrupt, and they should be able to repay their loans. But with this, they're going to be paying a little bit lower yield because of that, lower risk. And it's not going to show the exact yield on here, but this one's 2.8% yield if you look it up on Yahoo. The benefit with this is that you don't have to pay federal taxes on these. They're sheltered from that. So your yield would be effectively the 2.8% divided by 1 minus your tax rate. So if you pay about 25%, then you take it divided by 0.75, and that's the effective yield you're getting. And say it's up in the 3.7, 3.8, and that'd be tax-free, and you can just reinvest in that. They pay monthly, and I think that's just a really good investment. This is what I hold in my not Roth IRA. In my Roth IRA, I hold 2 other ones, which I'll disclose a little bit later. Okay. So the next one, which is one of the ones that I do hold in my Roth IRA, it is the Vanguard Long-Term Corporate Bond ETF, VCLT. And I really like this just because of the length exposure that I am getting here. So what I'm thinking with this is that it has been beat up over the last 5 years just because of the higher interest rates. Like I was showing you on that 10-year, we had substantially increased rates fast. Look at this 5-year. It went from 0.06 all the way up to in the high fours. This has made the ETFs not able to shift over their bonds fast enough, and they are holding lower yield bonds. So these lower yield bonds, the value, their face value on the market is lower. So that is why the price is down $72 per share of this ETF. So there's a potential return of about 40% there. Plus, these are paying about 5.8% yield. Where you have to be a little bit careful with this is you do have to pay taxes on if you're not having them in a tax sheltered account like a Roth IRA. I hold these in the Roth IRA, so I'm not really worried about the yield on it or anything like that. So I'm going to be not yield chasing, but taking a little bit higher yield and reinvesting that until the capital appreciation happens. Just show the top holdings right here if you guys want to look at those, and they have an expense ratio of 0.06. The other ETF, I'm not exactly sure what that one was. We can pop back in there in just a second. So that's corporate bonds. So that's going to be investment grade corporate bonds. So those are going to be pretty safe in that. But they are a bit more risky, and that is why they are yielding more than those muni bonds. If you just want to buy one thing, not have to worry about it, you just want a little bit of exposure to everything. You want a little government exposure, you want a little bit of corporate exposure, something like the BND, Vanguard Total Bond ETF would be great for you. It's yielding mid to high 3.8 or in the mid to high threes. This has also seen that price depression from about mid to high 80s down to 70s. And this, as you can see, it's a bit made up more of government bonds, which would be treasuries. And it's also made up of 26% corporate, and then also securitized bonds, which are going to be mortgages and stuff like that. And this has very limited municipal bonds, and that's just because those are more targeted towards the tax-free, and those do have those lower rates. And this isn't really targeting tax-free income. This is just targeting bond diversification. So I think that would be why they did that. Couple of the biggest holdings would be mostly U.S. Treasury notes. And as you can see with this, a little bit lower expense ratio with 0.03. I have held this in the past. I do not currently hold this. I decided that in my Roth IRA, I'm going to be holding it long enough. And I have the exposure risk or the duration risk where I can hold it long enough if it does happen to have higher interest rates for longer. Excuse me. Where I can hold something like the corporate bonds, get that higher yield and the higher potential return once interest rates do come down. Okay. So that was the kind of a more overall approach with that BND. One that I do own in my Roth IRA because I do not have any exposure to government bonds in my Roth IRA because of just that focus on corporate. I went with the iShares 20-year Treasury bond, which is TLT. This has been beaten up bad over the last 5 years. With these higher interest rates, they were up in the 150s, highest up in the 170s. They hit 170. Now currently they are down to $89.83 per share. These are paying mid 3%, but these are 20-year exposures. So these are going to be kind of like that corporate bond play I was talking about, where they're going to have a long exposure. So when the interest rates go up, they're going to be depressed even more than, on average, than a 10-year bond or a 5-year, 2-year, something like that. This is only going to help us once these interest rates come down. I feel like most of the damage has already been done, and now we're just going to be reaping the benefits from the higher yields, and hopefully we'll see the price appreciation over time. And this itself has had a run, 7.8%. If I want to click over here real quick, you can see these rates have just fallen off a cliff in the last 5 days. This has been able to push up these ETFs, just validating my theory a little bit. So it's going to be pushing these prices up when this 10 years coming down, because the assets held inside of the ETF are going to be worth more. So that is strictly corporate bond, or strictly treasuries in there, which would be the government exposure, which those are practically risk-free. And the last ETF, and this one I do not own. I have never owned it, and I'm not sure if I will own it. I'm going to be honest. It's SPDR, Portfolio High Yield Bond ETFs. I don't know if I'm going to own it currently. Maybe if rates do stabilize a little bit and I'm knowing the future a little bit more, maybe. But I'm just not sure about 2024 with a possible recession. And with this, it does invest into junk bonds, which are BBB or lower, which the other corporate bonds was investment grade only, which are BBB and better. So we do have a little bit more security in that VCLT. So looking at this, it has had a bit of a price appreciation, but on the 5-year, it is down 10%. So we could see a price appreciation in something like this also. With the exposure, it's mostly corporate, or not mostly, it's all corporate, sorry. And looking at the exposure, it's just not the best companies. What we were comparing it to was Anheuser-Busch and Pfizer and stuff like that. Big corporations that you know are not going to be going under anytime soon. But we're looking at some of these other companies in this ETF that is junk bonds or potentially fallen angels. Dish Network Corporation, which just had their CEO resign and had big other problems. I just don't know if I really want to put my money at risk. This portfolio does only have a rate of 3% failing, which is just on average with the junk bonds. And this expense ratio is 0.05. So not too bad of an exposure on something like that, which this one does yield up in the high 7s. So you do get a little bit higher yield for that risk, but I'm just feeling like something like the VCLT, looking at like this, it does have a little bit more exposure on the downside because of the length of the treasuries, or not the treasuries, of the bonds in the ETF. But looking at these companies, Pfizer, Goldman Sachs, CVS, Warner Brothers, Boeing, AT&T, AbbVie, these are just companies that I believe in a lot more than those other companies listed. And I know it's a 2% less, but it's not at risk of getting lost, I believe. These companies aren't going anywhere. It's just a lot safer play. And this is in my Roth IRA. This is something that I don't want to see disappear. I don't want to see it go down a ton just because a little mistake by me trying to get an extra 2%. I don't want to see that. And I think 5.5% tax-free, reinvested should be good enough. And that's just it's a big opportunity with that potential capital gains. But this has been JPay Investing. Thanks for watching. I hope you guys learned a couple things, maybe where you're going to buy some bonds, what you're going to buy. If you guys have any questions, you guys have any opinions, let me know. I'm interested. This is I'm not the most experienced in bond plays. I understand the correlation with the interest rates and how that all works, and it's really dependent on what the Fed does, and we'll see how that all works out. And also, sometime I'm going to have to show you guys through my portfolio, show you some of my other strategies, how I'm going to be trying to make money in this unstable market. But I hope you guys like this video. Make sure to subscribe, hit the like button, and have any recommendations for videos for me to make in the future, make sure to put them down below, and have a great day. Thank you.